Hi, founders. Welcome back to another episode of the Gab Lab, a show that's designed to bring you financial intelligence that won't only just blow your mind, it will build your bottom line. Today's episode are our good friends at Community Futures Manitoba, 16 offices across the province to help founders not only build their business, but to help them nail their numbers. I'm your show host, Tanya Woods-Richardson, and today's guest is Nail the Numbers Pro, Shauna Frederick. She's the founder of Frederick CFO on the Go OTG. She's also the co-founder of the Finance Café, an online forum for women entrepreneurs to help them nail their numbers. Now, today's episode is all about understanding financial statements, the fundamentals of these statements, and how they actually, when we pull them together properly and when we're measuring and monitoring them properly, they increase the value of the business. So please don't go away. We'll see you in the lab with Shauna. See you soon. Welcome to the Gab Lab, Shauna. I'm so happy to have you here today.
Well, thank you, Tanya. I'm thrilled to be here and thrilled to talk about something that I'm so passionate about. Not everybody is as passionate about numbers as I'm sure we are, but excited for the conversation.
Oh, beautiful. Well, I hope some of that passion rubs off because you're absolutely right. This is why we do the show. And today I am really excited to kind of take the conversations we've been having in the last several episodes. The framework for our show is always about profitability. It's always about getting business owners to understand the importance of profiting in business, not at the compromise of people, planet, purpose. We're not suggesting that, but profit is what makes a healthy business. And I am, this whole episode is really about the understanding the fundamentals of our financial statements. But where I see there being a huge correlation here is the first topic that we're going to dive into today is the balance sheet. And the balance sheet to me is kind of like the net worth of, what your business is valued at, hence why we want to profit. So I'm really excited to dig into this. So if you're okay, starting with the balance sheet, maybe you can just explain to the founders and to the audience exactly what the balance sheet is and the intention of the balance sheet and kind of give us a rundown on that.
That's great. It's a great starting point because it's often the first statement that shows up on your financial package. I want to step back though, because most people think that financial statements are either boring or look at them like they're written in a different language. But financial statements are so much more than numbers on a page. They can tell you the story of your business, what's happened in the past, and more importantly, we can learn and grow to our successful business that we're looking for. So you nailed it 100%. We look at our balance sheet as the net worth of our company. So we think about our personal net worth. We take our assets, everything that we own, our house, our investments, etc., and we subtract our liabilities, everything that we owe. So if we have a mortgage on that house, a car payment, whatever that looks like, and the net result of that is our net worth. In our company, the balance sheet is showing us the same thing. It's showing us the true net worth, what our company would be worth if we sold all of our assets, paid off all of our liabilities. That would be the cash left available to pay back to our shareholders. Go ahead.
So I'm curious though, because with a balance sheet, here's the thing that always gets me with the balance sheet.
Yep.
I know the balance sheet is designed to actually balance at the end, but what you mentioned here is that we have a leftover, and typically with the balance sheet, we never see the leftover. It's just, it zeroes out at the end. So can you explain that a little bit, why that happens?
You bet. So you're exactly right. It balances and there's a balancing formula. So that leftover piece is what we call retained, or is our shareholders' equity or retained earnings, right? So it's the formula because accountants love when things balance. So the formula on our balance sheet is assets equals liabilities plus shareholders' equity, or shareholders' equity equals assets minus liabilities. So when I say we take all of our assets, pay off all of our liabilities, what's left is our shareholders' equity, the amount that can be paid out to the shareholders.
Okay, so maybe to simplify that, if we take a look at, and I know a house is a really simple formula, but if we take that house and we understand that we have put down, let's just say it's a $500,000 house, we put down $25,000, or let's just say $50,000, right?
You bet.
And maybe you do the math for me, because I'm going to stumble through that and it's probably very clear for you.
No, I like using really easy numbers. So if we take your $500,000 house, say we've paid off $250,000 throughout the years. So the 500, our asset, less our 250 that we still owe to the bank, $250,000 is what's left. It's the net worth in our house. It's what we've invested into that house. Does that
Okay.
clarify it?
I believe so. So that's where we balance out. And then we also have, and I believe this translates in business as well, is that over that period that we have been paying the mortgage, minus the taxes and the interest rates, but as we've been paying into the equity of the house is also appreciated in value, right? As businesses are also appreciating in value. Do I have that right? Which is the asset piece that you're talking about.
You 100% do. And that's why it's key when we look at the net worth of our balance sheet, that's what it's worth on paper. It's not often that we increase the value of our assets based on their true net worth. So when business owners, when they're looking at their company, everyone thinks they have $1 million or $2 or $10 million company, but truly the value of your company is what somebody's willing to pay for it. Mm-hmm. But when we're looking at our balance sheet, it has to be our starting point of, okay, on paper, this is what our company is worth, right? So it's not necessarily always increasing the value. So say we have our company, say we own an investment in another company, we don't necessarily increase the value just because of the rules around the accounting gods. But you bring up a good point. When we talk about, often balance sheets will show something called goodwill. What the heck is goodwill? So when we think about investments in a company, if we were to buy another company, there's often an increased value of that company, and that's where it comes into goodwill on our balance sheet. So an overly complex item that I don't want to dig into too much here, because I don't want to overshadow the importance of, okay, this is what our balance sheet is really showing us. But just thinking of the net worth as what it's worth on paper. We know that when we go to sell something, there is always going to be what a third party is willing to pay for our company, because there are things like goodwill invested in our company. So we have our customer lists. When we go to sell our company, if we have a good solid customer base, there's an added value to a third party in that. If we have, machinery or equipment or patents, those particular items also have an increased value to a third party. So things like that will increase the value when it comes time to sell. But when we're looking strictly at our balance sheet on paper, it's the value on paper.
Interesting. Okay, so I have two questions. The first question on that is, would it be normal? What I'm hearing you say is that it is not normal to see goodwill on a balance sheet unless you're actually looking to sell or transfer the business over.
You'd see goodwill if you've purchased another company.
Okay.
Right. Okay. Goodwill, and also the other item, they're called intangible assets. So things like patents. So if you own a patent, that would be on there. So no, from an accounting standpoint, you won't always see goodwill on financial statements unless you've purchased the goodwill, we'll call it, of another company. So say you purchased a company and with that you bought, a customer base, that would be the goodwill that you're acquiring.
Sorry, I'm kind of smiling on that because I know there's several founders that are going to be watching this that are like, uh-oh, because on their annual financial statements, they've been showing goodwill year after year to submit to CRA. So that should be interesting. That's an interesting nugget.
It is, Tanya, but we have to remember where that goodwill came from. And the key thing when we look at our balance sheet, right? So it's a listing of our assets, what we own. Yes. So when we think about those assets of what we own, if we were to go and sell it, is there something that we could sell? Right? So we have cash, easily liquidatable. We have accounts receivable, easily collected from our customers. When it comes to goodwill, we have to look at how is that goodwill generated? And if we were to sell it, how do we sell it? Okay. Right? Is there things, when we look at it in comparison to, even inventory, right? Another asset, easily, I have a product, a widget, I can easily sell that. if we look at our capital assets. So capital assets are things like vehicles, land, building, again, tangible items that we can take and sell that item, right? When we talk about goodwill and intangible assets, they're not as easy to say, oh, here, I have this item, I can
Right.
sell it to you. So it always goes back to how was that goodwill created and how do we then sell it to a third party?
Beautiful. Okay. So I'm hearing a couple really important things there to just drill home for founders listening.
Great.
If you're seeing goodwill on your balance sheet, and unfortunately, I think you probably see this all the time, Shauna, but unfortunately, a lot of founders are looking at their statements 4 years or 4 months after year end, right? And they're, what is this? What is this? But so if you're looking at goodwill, and we'll talk about how often to look at your balance sheet, but if you see that coming up there, to ask the questions, right? What does this include? Give me a breakdown so that the founder is aware of it. If you haven't built your own balance sheet, if you're turning to an accountant or a bookkeeper to do that.
Yes.
Okay. And then the other piece to just hammer home for people, on the asset side, you mentioned there's cash, there's your accounts receivable. Just on that note, when is it stale? When does it kind of go into bad debt? Is that just at the end of the year? Like, are you showing 120-day, 100 or do you just whatever's still received into the business?
Important to be looking at. So let's just talk about our assets for a minute. So we have cash, inventory, accounts receivable, fixed assets. And I just want to nail home the piece of the difference between current assets and long-term assets before we get into that stale piece. The importance of separating your current and long-term assets for a couple of reasons. Once we separate them, we can easily tell how liquid our company is. So how easily we can convert those current assets like cash, inventory, and accounts receivable into cash to pay our bills. Key item all business owners need to know. Do I have enough liquid cash, liquid assets to pay my bills? And then we look at our long-term assets. So things like land, building, equipment, vehicles, those types of things. And the reason why we separate those two, one item, the current assets, can easily be liquidated into cash in less than 1 year, usually. And then we have our fixed assets, which you would normally hold on to for more than 1 year, things like equipment, land, buildings. So back to your question on at what point does it become stale dated? Inventory and accounts receivable are two key current assets entrepreneurs should be looking at monthly, if not more often, if they're coming into a cash crisis. So if they're not financially stable, they need to be monitoring these items. So things like accounts receivable, we sell, for the most part, entrepreneurs, founders sell items on credit. We normally give 30-day credit terms. Okay, so if you're not collecting that cash in 30 days, that's cash out of your pocket. You're using money out of your pocket to finance your customer's purchase. Inventory, same thing. I've seen so many businesses get into trouble when it comes to inventory because they start buying either flavor of the month items or they get a good deal because they can purchase bulk for less money. But what happens is when you think of inventory as little dollar bills sitting on a shelf that you can't use until it's sold to a third party. So
that are costing you, right? Sorry, Shauna, to interrupt, but they're costing you because you usually bought that with a loan, right? So
yes, so not only are you paying a loan with potential interest, that's money that you can't physically use. So I often say, we see inventory collecting dust in a corner somewhere. Think of it as dollar bills collecting dust in a corner somewhere that you cannot use.
Good call.
Right? So it's monitoring those items to make sure that you are selling it, converting it so that it's cash back in your pocket. And when we sell on credit, same thing. Once those 30 days are up, you need to be calling those customers, right? Finding out what's happening. And it's starting even before that initial sale takes place. You're building a relationship with your customers. Founders don't want it to be in a transaction basis. They want to be in a relationship basis, right? It's so much easier to call somebody who hasn't paid in 45 days if you have a good relationship. Mm-hmm. And oftentimes they'll call you and they'll say, you know what, I'm having some cash flow problems. Can we set, I'll give you $5,000 for 3 months to pay off that bill. Will that work for you?
Yeah.
right? Having those conversations is so much easier if you have a relationship basis as opposed to a transactional basis.
So important. It reminds me of episodes that we've done in the past, one with your colleague Shannon Peston, that is where we talk about it's so important to have the relationship with our lender. So if things aren't going according to our plan, we have that conversation. And so now I'm hearing you say the exact same, because we're a lender to our clients. Right.
Yes.
And so encouraging them, reaching out to them to have the conversation with us, to let us
Right.
know what that plan would look like and how we can piece it together, how we can
You bet.
alter the terms. So valuable. Thank you, Shauna, for that. Okay, so just on the other side, so we've talked about the one side of the balance sheet, which is the assets. We've talked about things to look for in terms of ensuring that that value is as strong as it can be, the short term and then the long term, watching for those things. Can you talk a little bit about liabilities? Sound pretty self-explanatory. I imagine we still have the same category, short-term, long-term, but what do we need to be aware of on the liability side of things?
You bet. So your liability is exactly what you talked about, right? So we have our current liabilities, which would normally be our supplier invoices, our accounts payable. So when founders are purchasing their supplies, they're normally purchasing on credit. And the same thing goes with our suppliers. Again, it's creating that relationship, right? So that we have a payment term set up with them, we're paying within terms. And where I see a lot of founders get into troubles is they want to, prove whether it's their worth or their credibility to their vendors. So they're paying right away. As soon as they get that invoice, that cash is going out the door. But and it's great. But when we think about the other side, if we're not collecting from our customer when we sell that product or service, we're now paying out to our vendors. So we're paying for that. And then we're giving our customer 30, 40, 60 days to pay us. So it becomes this lengthy amount of time that we're without cash. And more importantly, we've spent additional cash. So
Right.
important to have the relationship with your vendor, but also if they're giving you a 30-day payment term, take the 30-day payment term, right? They've given it to you for a reason because they believe you're credit worthy.
Yeah.
Take it. And then we look at our loans. So those would be our long-term liabilities. So say we own a building on our asset side, we have a mortgage that goes along with it. And those are just, they're separated under the long-term liability section with the 12 months that we owe in the first 12 months under the current section. And again, the importance of separating those two long-term and current portion is because we want to see if we liquidate our current assets, we can pay our current bills, and our current bills will be whatever we owe to our current suppliers, plus our 12 months owing on that mortgage or loan or whatever that financing structure looks like on your specific balance sheet.
Brilliant. Brilliant. Okay. And obviously in the loan side too, can you talk a little bit about the shareholder loans? Because I know oftentimes, and maybe this is a loaded question, so let me know if it is. This might be a whole other episode.
Sure.
But when we see sometimes accountants, when the owner hasn't necessarily been paid that fair market value or whatnot, or it continues to inject cash. So sorry, I'm going into two different directions here, but sometimes I see the shareholder loan for founders start to increase, sometimes with an injection and sometimes without one. So maybe if you can explain that piece a little bit.
Sure. So shareholder loans will often sit on the long-term liability side. And so often entrepreneurs are bootstrapping their startups, right? So they're injecting their cash into the company as opposed to going to external financing, which is fine if you have the funding in order to do that. So all that means is you're lending your company money, and when there's cash available, you can take that out. But for the most part, it sits under that long-term liability section. If you have a secondary loan through a bank, the bank will often ask you to defer your payment, so your repayment of your loan that you've injected, in advance of them. Fair. And also it sits under long-term because, again, when we look at that, do I have enough liquid assets to pay my current bills? We don't want to skew that data with money that we may or may not take out as founders for our own purpose.
Okay. Oh, so important. And, I'm very grateful that you're sticking around for this. I've kept you longer than anticipated for part one, but two more questions, if you'll allow me, just on the balance sheet. One, many founders that I have worked with over the years have used personal credit cards to finance portions of their business, to buy things. Would you see that as a shareholder loan? Or would you see if they get disciplined and use one credit card for all their business expenses, would you see that being an expense of the business and the business just repays the credit card? Or would you prefer to see founders, that credit card being recognized as a shareholder loan on the balance sheet?
So my first preference would be that we have a separate card for the business. Right. So it's key. It's important that founders understand that their business finances need to be separate from their personal finances. That being said, the two are interconnected because our businesses often fund our personal finances. Okay, but we need to keep those separate so we're not mixing things up. And you bring up a very interesting point that I've seen so often with founders. They will purchase something on their personal credit card, but oftentimes it doesn't get reported in the business. So when we're using our personal cards, sometimes we forget or we're just busy. We don't end up putting that in our business. So we're missing out on a couple of things. One, if it's an asset, so if we buy some equipment, we're not accurately reflecting the net worth of our business. Another piece, we're not repaying ourselves for the item that we purchase, but you could be missing a deduction in your company, which will then decrease your taxes. So there's a whole gamut of reasons why you need to be able to keep those separated as opposed to commingling finances.
Okay, and the last piece, Shauna, just in this part one on understanding the balance sheet.
Sure.
Oh, this is another loaded one, but amortization.
Yeah, when we think about buying a vehicle, we record it as a long-term asset, a capital asset on our balance sheet. It doesn't immediately get expensed as a deduction on our income or our profit and loss statement, which we're talking in our next segment. So what does that mean? Well, we have this asset, but we know that its value depreciates or reduces over time. So what happens in the accounting world is we take the value of that asset and we expense a portion of it every year on our income statement. So as opposed to expensing 100% of that vehicle the first year we buy it, we take it and we expense it over time. And again, when we think about the value, our net worth of our balance sheet, we want to make sure that those fixed assets, like our vehicles, are sitting at a reasonable value. And more importantly, if we get rid of that asset, we need to let our accountants know so they know to take it off our books so that our companies aren't overstated.
Perfect. Okay. And thank you for clarifying that, because I think it's an important question to ask your accountant, to ask what sort of model that they've used for amortization, right? I know that sometimes the short term is, it looks good if you accelerate the amortization because you're paying less tax, but then in the long term, I don't want to say depreciating the value, but you're definitely impacting the long-term value of the business because you're writing off the asset faster, right? So what I love about what you've said here, if it isn't clear for founders, because this is a loaded topic, I think we could do a whole episode just on amortization schedules. Ask your accountant what format they've used and what position that puts you in short term and then long term, because that's why we do these shows, right? Own the numbers. It's all about taking ownership of the decisions that you make. So don't abdicate,
Absolutely.
right? Just
absolutely.
Abdicate. Okay.
Can I add on to that, Tanya? Because
Please.
I think it's important that, founders go into business because they have a passion or a solution to a problem, and they're excited about taking it to market. They're often not accountants. They often ignore their financial statements, as you said, until 4 months after year end.
Yeah.
So I really encourage founders to have that courage and just that ability to ask for help. So two favorite authors of mine, Adam Grant and Brene Brown, talk about confident humility. So as founders, if you're not understanding what the financial statements are telling you, reach out for help. Your accountants are there. And oftentimes as accountants, I've done it myself. We go through because it's second nature to us, but you need to ask for clarification. Show me an example. Help me understand this because I do not understand where this number is coming from. And I need your help in allowing me to understand that. So confident humility, have the courage to ask for help where needed.
I so appreciate you bringing that up because this is a topic that's cloaked in a lot of shame and secrecy and guilt. And I have often found, especially for founders, it's compounded because they, there's this expectation in society that as business owners, we're supposed to understand the numbers. Right. So it's, what is already an issue across the country, across North America is now just, again, a deeper one, a deeper cut for a lot of founders because there's this expectation. So thank you for that. And I love that you've thrown in some authors here. And one author that comes to mind specifically on this balance sheet conversation is Rich Dad, Poor Dad. Right.
Yes.
Because he's brilliant in talking about don't get stuck. Yes, we have to do a cash flow and I love cash flow and I love planning, but the balance sheet is what is increasing the value of your business. If we focus on increasing our value of the business and now I'm getting into behavioral finance, so sorry everybody, but appreciating our value typically reflects in the value that we start to build in the business, and that's where we need to be focusing, right?
You bet.
So
our next segment we'll talk about how we increase the value on our balance sheet.
Love it. Okay, well, thank you for staying the course. This was longer than expected, but so much important information in there that I think there's a lot of aha moments happening for founders that are watching this. So thank you for being here. We're going to see you for part 2, which we're going to get into the income statement. Founders, take a quick break, go refresh your coffee, and then we'll see you back in the lab here for part 2. See you soon.